Good afternoon. Welcome to today's market review. My name is Stock Darts, and we're going to do what we normally do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those, we'll take a quick look at the US dollar. We'll also see how oil, gold, silver, and Bitcoin are behaving, and then we'll move on to chart requests. If anyone in here has a chart request, feel free to type it into the chat bar, and I'll be more than happy to take a look at it once we get a chance. If you like what you see here, you can always follow me at Twitter at StockDarts. You can find these videos posted on YouTube under the same name, StockDarts, or you can visit me at patreon.com/StockDarts, where I post weekly blog content including trade ideas, as well as just generally expanding on some of the information we cover during these Wednesday market streams. Typically what we want to do here is analyze what kind of market environment we're in, and then make sure that we try to trade according to that. So if we're in a strong bull market like we are now, then we want to be looking to trade to the long side. If the market's correcting, then we'll be looking at the appropriate trades for that sort of environment as well. All right, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500 using the ETF SPY. All right, so as you can see on the S&P 500 here through SPY, we had an interesting day today. We opened up very strong, and then we've kind of sold off. It's not really a surprise considering where we are on the chart and what the market has done over the last couple of weeks. We've had a very bullish last couple of weeks, and you'll note we kind of discussed this possibility last Wednesday when we were looking at exactly where the markets were and where they could go. And as we go through the four major indices, we'll see exactly what kind of pattern is playing out here. But just looking at the S&P 500 and seeing what SPY has done, you can see that we made our way from the bottom of this channel all the way right back to the top, and now we're starting to struggle as we try to break through the top of this channel. Typically, in these kinds of scenarios, this is sort of like a lose-lose situation for the price action, because if you're able to push through and break on the top side of these rising channels, that's usually the beginning of a blow-off top or of the last sort of big push of momentum before you turn around and correct. And of course, if you don't break through the top, well, then you're going to correct anyway because you've hit a wall of resistance, or you've bumped into the ceiling, and now you got to kind of come back down and start figuring out exactly where the floor is. So, at this point, it's kind of one of these situations where the market is kind of stuck, where it should be pulling back regardless of whether it actually behaves more bullish in the next couple of days where it doesn't. For those that read my Monday blog on patreon.com, you'll know that this was a week where I planned on sitting mostly on my hands. We've had a bunch of monster trades over the last couple of weeks, and so I looked at a couple trades that were likely to give us some potential profits, but generally speaking, the risk reward's not that great right now. And so traders are better off basically just kind of riding the wave with the stocks they already own, or only taking trades if you find stocks that give you good risk reward. And we did find a couple, and one of them is actually working out quite nicely. The other really hasn't given us any entry yet, so it hasn't actually triggered. But when the market is up like this, like it's been 1, 2, 3, 4, 5, 6, 7, 8 days, so it's in the last 8 days, it's basically has 5 or 6 green candles, and even the red candles were still kind of closing higher than the previous day. We just closed lower than the open. And so you have a market that's very strong, but what ends up happening here is that the risk reward is poor the closer and closer we get to the ceiling. And as you can see at the top of this channel, we've got all the way back down to 375 before we really hit any kind of support on the S&P 500. And our resistance is really right where we're at, because we're kind of having trouble through these all-time highs and through the top of this channel. So it makes it difficult for a trader to want to go ahead and try to take advantage of this and look for good trading opportunities, because really all you're doing is chasing the price action higher unless we get a change of character here in the markets. And so I found it a little bit difficult to find good trades this week, because again, most of the stocks that you'd want to trade to the long side have already broken out. And those that are still giving you good risk reward are usually the stocks that have actually pulled back during this, which is usually not a good sign. So really it becomes difficult to find good trading opportunities unless you find a stock that is consolidating near highs because it was kind of ahead of the curve and had broken out before the market kind of came up and started breaking through new highs. And so that's where we stand right now. We can always play the rotation game, which is actually what happened so far this week, with the small caps breaking out faster and more quickly than the S&P 500 and the Nasdaq. And we'll get to that once we reach IWM. But for now, just looking at SPY in a vacuum, we can see a market that is bumping its head against resistance, and risk reward is not really in a good place, making it difficult for us to get too excited about trading to the long side. Now, that being said, I've been seeing a lot of stuff on my social media feeds about traders saying, is this the top? And kind of worried about the market. It's kind of interesting because really we're only down 0.2%. And even on IWM, which is the index that is down the most, it's not even 1% down. And so, there's still a lot of people that are jittery about this market, and for good reason, I think. When you look at the exuberance that we're seeing with a lot of stocks really starting to break out, we're starting to get price action that's reminiscent of what we were seeing back in 1999, where you have this influx of traders that are jumping in because they're expecting everything to go up, sort of like the GameStop situation we had a couple of weeks ago. And when you see this kind of momentum and you see this kind of exuberance, you start to wonder if this is going to be the end of it. But that being said, the one thing I want to point out is until we see a change in market character, until we see the chart actually change, our assumption is going to be that the stock market is going to continue behaving the way that it's behaving at the moment. And that's a really critical thing to point out. That's something that's important for traders to understand. Those are the regulars here. You'll know that we talk about this all the time, and that it's not our job as traders to predict where the market's going. Our job is to react to what the market gives us. Anybody can make a prediction, and there have been people that have been calling for a top on the S&P 500 for 5 years now, and eventually they'll be right, and then they'll kind of bang their chests and say how they were right about predicting the market. Meanwhile, they lost God knows how many short trades in the interim. And so what you want to do here is, I've been kind of leery about this market since the turn of the year, but it continues to go up. So what I've been doing is just trading to the long side and continuing to take advantage of this momentum until I see the chart show me something different. And if the chart doesn't show me something different, I'll continue to take the trades that we've been taking. And like I said, we've had some pretty big trades over the last few weeks. Just to kind of recap a few of them, a couple of weeks ago we were looking at Workhorse as one of our long plays, and this will give you a good idea of the kind of risk reward that I'm looking for. So we were looking at Workhorse right here as it was breaking this descending trend line. As you can see, it was giving us at the $24 level, which is right around where it was going to break the 20-day and the 50-day, it was giving us about maybe 2 points of downside, maybe 3, with upside all the way up to 31, which was 7, and then beyond that was just kind of gravy added to it. But you can see we got all the way up to 40, and it's still actually producing. It still hasn't really given us a sell signal to close the rest. Now, of course, I took profits along the way, with most of my profits around 30, and then again right around 40. But there's still a little trailer position going in the event that we actually get a little bit further. But you can see it's starting to slow down a bit. But this gives you an idea of the kind of risk reward we're working with. Another trade from that same week was Novavax. And as you can see, Novavax, again, huge explosion. Once we're looking at it inside this consolidation range, giving us, again, a break of 135 with a stop around 121 is about 15 points of downside. But obviously you're looking at 50, 60, 70 points of upside, and actually well beyond that at this point that it's reached the $300 level. And again, so this was just two of three trades that I predicted, or that I put on my trade blog on Monday of 2 weeks ago. And then last week we were looking, again, usually I put 2 or 3 ideas, and so this was one of them, was CYCN, CYCN. And I don't know if JB's here, but he's one of my Patreon members that took this trade. And again, you can see the risk reward that we're looking for here. We're looking at a trade that on a breakout is going to be maybe a point of, or maybe 30, 40 cents of downside, and we're looking at about 1.5 points of upside, and then obviously beyond, we got all the way up to the gap fill at 660, which was not anticipated at all. I really wasn't looking for anything beyond $4, but when you get this kind of explosive price action, you just kind of jump on and ride the wave. And then last week as well, one of the other trades that was working in our favor is Vareet, which is not quite as explosive as the others, but again, you can see the risk reward that we're looking for here. We're looking for maybe 2 points of downside and about 4 or 5 points of upside. And again, this trade is working really well for us. And so when you have a market that's moving upwards, even if you don't trust it, you still want to go ahead and take advantage of the upwards momentum, and particularly now that we're seeing some pretty explosive price action in the market. And so you want to make sure that even if you feel distrustful of it, or you're not really excited about the way the market is behaving, that you go ahead and still try to find your opportunities, because any one of these trades basically could have made someone's year. And it's only February, and just one trade on NVAX is likely enough to make someone's entire year. To get a stock to go from 130 to 300, that's usually enough to buffer losses for the next 2 or 3 months, even if you're not a good trader. And obviously, if you're a good trader and you pick up on two or three of these, well, it's going to be difficult now to really struggle, and the market will give us it'll give us tougher price action, probably very soon. And having the buffer of profits from some of these trades is going to be able to give us a better opportunity to withstand when we start losing two or three trades. So far, the last 3 weeks, we've had 2 out of 3 trades work in each of these scenarios. And so just to kind of be, totally honest here, some of the trades that didn't work. I had an earnings trade in Amazon that did not work, because I was expecting it to stay in a certain range that it did not stay. And that kind of worked a little bit against me. It wasn't a big mistake, but that was one trade that did not work. And then the other one was we were looking at a long play on Coca-Cola. And it actually worked eventually, but it didn't work when I was looking for it. We're looking, again, you can see the risk reward that we're looking for, though, right? We were looking for it over here to break about 48, and then make its way back up into the 50s and possibly beyond. And instead, I got a stop out when it came back down to 48. But again, what are we looking at? 1 point of downside and 2, 3, 4, 5 points of upside. And while it didn't work, this was during the same week that we had, I believe, the Novavax and the workhorse. So in the end, it all worked out just fine for us. And so when you have these kinds of trades, you'll notice you lose maybe 1 or 2 points on the bad trade, but you get 10, 15, 20, depending on your risk parameters on the other trades. And so you end up working out for you, as long as you can structure your trades in this way, and you don't just chase what the market is giving us, right? And so the market right now, if someone is going to chase a chart that's doing the same thing as the stock market, well, then now what do you have? You have what, 17 points of downside. How many points of upside? 2, 3, 4. So you don't want to chase the action here. What you want to do is either wait for pullbacks into moving averages, or find stocks that are giving you good risk reward. And so, just to give a little peek into what we're doing this week, this was one of the trades we're looking at this week, and it started off okay for us. We've got we're looking at yesterday a breakout at about $60, and it went up to about 63, 64 today. But we're still looking for more. We're looking for at least another 2 points of upside. But again, you can see the risk reward that we're looking for here, where we're looking for a move with downside of a few points and upside of more than that, particularly in this case where I expect it to possibly go beyond that and continue climbing upwards. And so, when you're looking at the stock market, even if you feel nervous about it, understand that as long as you take the right types of trades, you can still go ahead and make money, even if the stock market, even if you don't feel good about it. You have to take advantage of this momentum while it exists, because we're getting explosive moves all over the board. Those stocks that I just showed you, I'm not some kind of genius that picked the 5 best stocks in the last 2 weeks. There are at least 30 or 40 moves that have been the same type of move throughout and all across the markets. And as long as we continue to see this price action, there will be stocks like that are moving. So we just want to make sure that we're paying attention and taking advantage of these trades while we have them, because we won't always have this kind of explosive momentum. All right, so looking at the S&P 500, what are the key levels that we could pay attention to, and how are we going to go ahead and navigate this moving forward? Give me 1 second. Okay. Sorry about that. So looking at the S&P 500 and looking at the key levels that we need to pay attention to, I think at this point, when you have a channel that's trading like this, obviously the key level is the bottom of this channel at this point, right? But we have the 20-day moving average in between, and there's a decent chance that once we do stall out at these levels, which I expect, I think there's, if I had to gauge from here to next Wednesday, I assume there's probably about a 75% chance that we fall back and maybe a 25% chance that we continue higher, if that. So chances are, more likely than not, we're going to come back and we're going to test lower. Now, the key is, how far down do we go once we start testing this channel? Because a lot of times, the expectation is once you hit the top of the channel, you come back and test the bottom. But it doesn't always play out that way. As you can see, if we just go back and backtrack, once we finally tested the top of the channel here in the middle of December, we came back and tested the 20 and then made our way back up and actually tried to explode past here. And then we came back and tested the 20. And again, we didn't, we had these couple of wicks come down to the 20, or down to the bottom of the channel, but we still kind of came back up. And then again, once we came over here, we tested the 20, and we came right back up. And then it was the last time that we broke through the 20, came and tested the 50. So not every single pullback comes all the way down to the bottom of that channel or to the 50. And so the first key level we want to watch is going to be right around the 20-day moving average, which might also coincide with this 385 level, which was the previous highs. And as you can see, again, if we just go ahead and let's just move these trend lines away for a minute and take a look at this, try to take a look at the action in a different light. You can see that we had a nice consolidation range. And as we stair-stepped, right, and you can see even if we go ahead and use this rectangle again, you can see we had another consolidation range here. We had another one here. So the market, even though it's been in a nice channel and kind of trending upwards, it has had these nice little stair steps as it makes its way upwards. So there is the possibility that we're just going to make another one of these within that channel, right? And I think this is, by the way, a good exercise in showing how a lot of times what you see in a chart is based off of your point of view and your frame of reference, right? Because there's a lot of different ways that I could draw trend lines on this chart, and I can make it look bullish or I can make it look negative. And basically, just kind of point the lines whichever way I want the picture to look. And so it's important that when you look at a chart, you understand that what you're seeing is not necessarily what everybody's seeing. But as you can see, we're in a nice little trend, but we're also stair-stepping slowly. So the first level of resistance or of support would be right around these highs, around 385, and it's likely that the 20-day moving average will catch up to price as it comes down to meet. If we fail there, then we're going to come down and probably test the bottom of this as we test the 50-day again. As a trend starts to mature, the 20-day becomes a little less significant, and the 50-day trend, 50-day moving average becomes more significant. And that's just a function of math. Anyone that's ever traded using moving averages, at some point, the moving averages are going to cross through price. It's just the way math works, right? It's the average of the price, and it can't stay below it permanently. At some point, it has to kind of cross, and price has to cross below, and go back and forth through it. And so as a trend starts to mature, eventually the numbers kind of catch up, and the moving averages are going to come through price, and it's going to have to come down and test the longer term trend, and then eventually even the longer term trend all the way down at the 200. So what we are looking at now is a trend that's starting to get a little bit, clearly there's plenty of room for it to continue upwards, especially within the perspective of just looking at this move that started during the holiday season. However, what often happens here is that we need to test the lower moving averages in order to find buyers and in order to be able to kind of sustain the move back up. Once we get people taking profit and we get the weaker hands that are chasing the price action up today to kind of give back their shares and then let the smarter value investors come in and buy it at these lower levels. And so I think those are the key levels that we want to watch on the S&P 500 right now. We want to pay attention to 385, and we want to pay attention to the bottom of this channel, which is also going to be right around the 50-day moving average. Anything below that is not anything that we need to concern ourselves with at the moment. If we break through this channel, then obviously we need to step back and reevaluate where the market is going, because it will no longer be in this clear short-term trend that we have. However, it will still be in a very clear long-term trend. If we look at the weekly chart and we see what we've done since March of last year after the pandemic scare, even amidst and through the entire year where our economy was really stuck in neutral, if not going backwards with all the shutdowns, the market continued upwards. And we had a massive trend that basically sliced through the huge drop that we had. And that has really not stopped. And so even if we do pull back, even if we break through the 20 and through the 50, and we come back down and we start testing lower, the long-term trend is still intact. And until that changes, we continue to play this as a bull market. And that's going to be for a while. Now, does that mean you should ignore your stops? No. Obviously, we still want good risk reward. We still stop out of trades, as I showed you with that Coca-Cola trade. Even if the market is erasing a lot of mistakes, you don't want to be caught up in a bad move, because there's a lot of room to the downside where the bull market is still intact, but your account might not be. So don't just buy here at, say, 390 because we're in a bull market, and then we get a massive correction. We get down to 375 or we get down to 350. And you say, well, I'm holding because we're in a bull market. Well, you don't have any money left because you held through 50, 60 points of downside because you stuck your head in the sand. Make sure that you are still using the right discipline and using the right criteria for taking your trades. Now, let's look at the Nasdaq. Now, the Qs are much like the S&P 500, doing the same sort of thing. We kind of gapped higher and we've pulled back. We've got a little bit of hammer candle up here. Now, hammer candle at highs, as I've mentioned over the last few weeks, as we've seen a bunch of them, that's usually not a bullish candle because it shows that there's selling pressure. And it shows that we're running into pockets of supply or distribution. And I didn't draw the top of this, but we're basically doing the same thing. We've got a nice little channel, and we're kind of just grinding upwards. And until we fall out of this channel, we have to assume it's going to continue trading this way. Now, you'll notice, relatively speaking, the Nasdaq is stronger than the S&P 500. We actually didn't test the 50. The entire channel rests above the 50 rather than using it as the floor. And so there's more room to pull back here and still maintain the bullish trend that we're seeing. And that's been kind of par for the course for the Nasdaq over really the last decade, but particularly over the last year, with a lot of the tech names being sort of insulated from the shutdowns that we've seen because of the COVID pandemic. Where stuff like Amazon and Netflix are actually going to benefit from us staying home. So the tech names continue to be a good area. Now, over the last week, a lot of the Fang stocks have actually behaved poorly, and that has kind of led to the Nasdaq kind of getting stuck a little bit in neutral. But overall, we're still looking okay. So just to kind of recap real quick, here's Facebook. You can see Facebook is not really in the best place compared to what the market's doing. Amazon, another one that's kind of stuck in neutral. Apple is doing a little bit better, relatively speaking, but they've also been kind of stuck a little bit over the last few weeks. You can see they're nowhere near all-time highs. Well, they're near all-time highs, but not as close as the market is. And then we have Google, which is the one that's a little bit different. You can see they had strong earnings and have been kind of running upwards since then. And this is a little bit closer to what we're seeing on the overall charts. And then Netflix being the last one. And Netflix, again, they're off of highs again. So the five major Fang stocks, only one of them is really at all-time highs. The rest of them are kind of off and still trading near their moving averages. So it shows a little bit of rotation outside of some of the big tech names. Now, the Qs are actually still doing okay because there have been other tech names that have kind of been holding it up. But the major components, which are the Fang stocks, have actually been struggling a bit. Now, there's two ways of looking at that. One is that money's rotating out of the Qs. Two is that eventually money will rotate back into them and the Qs will explode again and lead the market higher, because you don't often see the Fang stocks perform poorly within the midst of a bull rally. And so if they start to gain some momentum, then we're going to see a new leg in our bull rally as money rotates back into them. And so it's important to keep in mind, this is one of the things that I was talking about before, where you might see a market that's extended and feel like at this point you don't want to really trade it, but there's actually plenty of room for us to continue higher if money rotates back and forth as it's been doing between the Nasdaq and the small caps of IWM. And we'll get to IWM in a couple of minutes. and we'll see the difference here. And so it could be the case that money rotates right back out of IWM and back into the Nasdaq, and the Nasdaq continues to grind higher, pulling the rest of the market with it. So just another little bit of advice as far as how you want to go ahead and manage this. Understand that money can rotate back into these names, which would lead to another leg up in our bull market, even if it doesn't look like it at this point. Now again, I think the more likely scenario right now, considering we're grinding towards resistance, is that we pull back and retest some of these moving averages. But keep in mind, there is the possibility that the Fang Stocks regain momentum and just keep dragging the market up along the top of this channel. As you can see, unlike the SPY, we haven't really quite hit the top of this channel. It depends on how you draw it, I guess. If you lower it a little bit, you could say we're grinding on the top of it. But the truth is that really this is all theoretical, and it really just depends on what the market wants to do next. Now, if we look at the Dow Jones, the Dow and IWM, which we'll get to in a minute, actually had a very nice explosion from last Wednesday to this week. And you can see last Wednesday we were discussing how the Dow Jones was really our tell as to what the market wanted to do next. Because of the four indices, it was the only one that actually had a bearish pattern going. Because we had a breakdown below our channel, and then we had a retest that was failing. And you can see we even struggled versus the 50. Compare that to the channels that we saw on the S&P 500 and the Nasdaq. The Nasdaq's channel is nowhere near the 50, and the S&P 500 has been able to hold within their channel this entire time. And meanwhile, the Dow Jones was actually breaking down below it. Then we finally had the big move as we had this conflict between sellers and buyers. That's why I highlighted this as red and this one as green. As these were the bulls in the short term, these were the bears in the short term. As you can see, the bulls went out. We had to break through the 20, right back through all-time highs, and push back beyond that. Now, part of the reason for that was, again, there was some news that came out as far as more stimulus coming to some of the travel industry, particularly the airlines. And that kind of gave a boost to airlines as well as to some of the industrial names and some of the energy names. But a lot of this is still a pattern that has been playing out throughout the last several months, which is money rotates into two different areas of the market. One is the tech names that have benefited from the pandemic, and the other is some of the more industrial names or some of the more energy-related or just travel-related names that benefit from a vaccine and from the opening up of our economy. And what we've noticed, or what I've noticed, is there's been a nice give and go where you'll get some of those names, the energy names, the airlines, travel industry, they start to do better, and the tech names slow down. And then eventually there's a scare or some reason why people think maybe we're not opening up as fast as possible. Money rotates back into tech and away from the Dow and away from IWM. At the moment, we are in a situation where money's flowing back into some of the beat-up areas, and you can see that with the Dow starting to climb up. Again, a hammer candle at all-time highs is not really positive, but it's not negative necessarily. And as you can see, we made new all-time highs. We came back, and we are testing and trying to stair-step above and stay above this recent level of what was resistance and is now trying to be support. And so a little bit of a different picture compared to what we're seeing on the S&P 500 and the Nasdaq. Now, if this rotation continues, we'll see the S&P 500 and the Nasdaq test their moving averages, and we should see the Dow and IWM maintain some of these levels that they've just broken through. So if money stays in these areas, then the Dow should stay above 311, 312. If it falters and comes back down to the 20-day moving average, then the question is, do all the markets correct together, or do we see money rotate back into the Nasdaq, which tries to move forward? And so that's a relationship that we need to continue watching, because it's been pretty predictable lately, and it keeps going back and forth between the two. Now, key levels, if we're just looking at the Dow in a vacuum, like I said, we've got, in very short term, we've got 311 as a support level. Below that, we've got the 20, which would kind of coincide with this channel if it wants to maintain this longer than what it has. And below that, we're going to come back to the 50. Now, move below this ascending trend line, below the 20. That's a negative, and that shows that the Dow is probably transitioning to a more neutral formation and a more neutral price environment, and it likely means that we're going to continue start to base out and trade sideways, probably in the markets in general, not just the Dow. So that's one area we want to watch. Is we don't really want to see the Dow come back into this area between 308 and maybe 300. If it falls back into that, then as you can see, we've gone from an uptrend to a sideways trend. And again, it's not necessarily negative. It doesn't mean it's a top, but it does mean that the rally is probably dead, and we need more time to trade sideways and kind of churn through some price action. Now, we look at IWM, we can see a much different picture. And again, a very explosive move over the last over the last week, especially since last Wednesday. And it just continues to climb higher. You can see nowhere near the 50. In fact, this is pretty steep, and to the point where it's kind of pointless for me to draw a channel for it. I could draw this channel, but it's typically channels this steep don't maintain themselves very long. And as you can see, we've actually accelerated through the top of it, right? And so again, this usually happens towards the end of a rally, but not ready to call that yet with IWM, because again, it's been so explosively strong that the channel really isn't that relevant at the moment. Really what's important is the 20-day moving average, which is what's supporting price more than an ascending trend line. It's the fact that it comes up and hits the 20, just keeps rocketing past it. Eventually we will break the 20 and have to come back and test the 50, but at the moment this is a trend that's very strong and very intact, and until this changes, we have to assume that the stock market is still in a bullish phase where traders are willing to assume risk. And you can see, even when we had our little corrective phases, they were pretty shallow and pretty quick, and then we had our big moves upwards. And so even if we do pull back again, you can see that we're pretty far off from our previous level of resistance, and that should act as support, which again will probably coincide with the 20-day moving average. So you know, there's a decent chance that if we do have some selling in the market, that IWM maybe comes back and tests around this 215 area. But really it's the 20-day that we want to watch more than this, because when you have a stock this strong, it tends to use the moving averages first and then trend lines later. And so that is going to be the area that we want to watch. And then beyond that would be the 50-day. This again highlights the rotation back into small caps and the explosive move that comes into it. A lot of energy names in particular have done really well. And when you're trading, like I said before, you want to be aware of these patterns. You don't want to just be the guy that says, you know, looks at the Dow, and because the Dow's what they say on CNN, and just make all your trading decisions based off of this. There's a reason that I like to go through all four of these indices. Is as we go through the four of them and we understand the relationships between them, it gives us a better idea of what the market's doing and how the market's behaving. And so at the moment what we're seeing is money rotated back into some of the areas that have been struggling over the last year, and away from some of the areas that have done well over the last year, which is namely the Nasdaq and the big tech names. Sooner or later that'll change, but until it does, we want to watch these areas and look for stocks that are going to be trading along them. So if we look at the four major markets altogether, the S&P and the Nasdaq both look like they needed to pull back and test lower in their channel. However, if you look at the Dow and you look at the IWM, they look like they just want to consolidate for a couple of days and then try to get the momentum going forward. And so as an aggregate, what we have is a market that's still pretty bullish, even if it might need to pull back. And that means we need to do the same thing that we've been doing the last couple of weeks, which is making sure we don't chase the price action, understand our complete allocation in the market, and try not to expose ourselves to too much downside risk, but at the same time take advantage of this upside momentum and make sure that we are taking trades and make sure we are taking profits as this goes up. You know, when you have momentum like this, it's easy to kind of just hold and not take any profits. But one behavior pattern that I found works really well for me as far as trading, or one trading process that has done well for me, is when you have something that explodes like this, I like to take partial profits as it moves up and then hold a certain portion, maybe a third, maybe 25%, maybe 20%, maybe 10%, and let that ride out and play the momentum off of that, but lock in profits as we hit levels of resistance that are kind of important. And that keeps you insulated from whenever this eventually does kind of end and we eventually get the much steeper drops. However, from here to next Wednesday, I don't anticipate a steep drop. I expect us to come back and test some moving averages, and that's the way I'm going to go ahead and approach the markets. Now, let's look at the US dollar real quick. We'll look at oil, gold, silver, and then those of you that are in here, if you have a stock that you want me to look at, I'd love to see it. Just let me know in the chat um, if it's a stock that you are interested in trading, or maybe a stock that you have a chart that you have a question about. But here's what we have with the U.S. dollar. Now, the U.S. dollar had a nice bullish move last week, but as you can see, this week it's been pretty much basically since last Wednesday, it's been straight down. Uh, I think overall this is still okay because it looks like the U.S. dollar bottomed, which is really the important thing. Um, we have a lot of explosive moves across the board, not just in the stock market, but in cryptocurrencies. A lot of cryptocurrencies are going wild right now. A lot of collectibles are going crazy right now. It seems like people are just trying to find places to put their money in that is basically not the bank. And that's because the U.S. dollar has been so weak and continues to kind of flounder about with really no hope in sight of increased interest rates, which means people are not going to get a return by leaving their money in the bank. And so that shows that there's just less demand to hold the U.S. dollar. If we look at the Euro-U.S. dollar cross, we can see, and again, this is going to be inverse, so up is good for the euro, down is good for the U.S. dollar. You can see that the dollar had actually made strides against the euro over the last few weeks, but we're finally starting to see a rebound in the euro as it comes up and tests the 20 and the 50-day moving average. And this is actually a pretty important area here as we approach the upper 121 and into 122. And if the dollar is going to continue to stabilize and bottom out, then that means the euro should start to struggle here and top out, right? And so that means that we shouldn't see the euro get back above maybe 122. If it does get back above 122, that likely means the dollar is going to continue to head south, which likely means that we're going to continue to see stocks run, and we're going to continue to see maybe a bounce on gold and silver, which has been kind of lukewarm at the moment, and a definite bounce on Bitcoin and other cryptocurrencies. Now, interestingly enough, the U.S. Canadian has also struggled, but this is partly due to oil prices going up. But again, you can see the dollar had made some strides and had actually started to make its way back up, but now it's starting to fall back down and coming back to lows. And this is actually the currency that the dollar is struggling the most with because of oil, which we'll get into a second. For those that maybe are unaware, oil is one of the major trading products between the U.S. and the Canadian, the Canada, and a lot of times the Canadian currency trades with a pretty decent correlation to oil. And we'll look at oil in a second, and oil has been pretty strong. And then the last currency we like to look at is versus the U.S. versus the yen. And this is actually the one currency where the dollar has made strides. But even then, you can see over the last 4 or 5 days, it has given back a lot and has come back down. But we're seeing a trend shift here, and we're finally seeing the dollar bottom out. And even though we've seen a drop over the last few days, it was within it was something that was bound to happen. The dollar's not going to all of a sudden just rally straight to the moon. It's going to struggle and come back and retest. And typically in these situations, what we have is we had a downtrend that is now shifting to neutral, which means it's going to go back and forth between them. So now the key for the dollar is don't go all the way back to lows. Find levels of support and hold at those levels rather than just kind of give it all back. And so that's what we're looking at with the U.S. dollar. Now, before we look at gold and silver, let's look at oil. And you can see oil, massive move. It's gone from the low 50s all the way up to almost 60. Beyond what I was expecting. I really didn't want to see oil get above 55, 56. I thought that was going to be a good ceiling. And that has not been the case so far. It just continues to climb upwards. Now, it is reaching a point where there should be a pullback soon. If anything, just because of the normal ebb and flow of trading. But as we can see, something we noticed way back here when it was starting to break out of this range, we've got an alignment here. The moving averages are giving us a good idea here that there's a trend building here that can persist for a while. This was to be expected, as this is a good sign that it shows that our economy is expecting more energy demand or energy consumption, and that's going to be reflected with oil prices. As there's more demand, as we start to use more energy, we're going to need more oil. And that's really what's going on here. However, you don't want oil to shoot back up into triple digits or anything along those lines. Obviously, that's really far away from here. But, we still want oil to maintain a normal trajectory here where it's stair steps. We don't want this to start to get too explosive to the upside, as that could put a lot of pressure on us price-wise. This could also be a sign of an increase in inflation. And so what we have here again is oil has been up 1, 2, 3, 4, 5, 6, 7, 8 days in a row now. there's a decent chance it pulls back a bit, but we have a strong trend in place here, and energy names have done well, and they will probably continue to do well. Although if you have energy names that are mimicking this chart, you might want to take some profits and wait for it to pull back before you want to go ahead and reallocate it to whatever it is you want to do with them. Now, in contrast to all of this, gold and silver have been just stuck in mud, and this is pretty sad when you consider the state of what the U.S. dollar has done. Uh, I still don't have a 100% grasp on exactly why gold and silver have been shunned so much by investors. I know a lot of it is there's been this big transition into Bitcoin, but that can't be the entire picture. However, I'm not a fundamentals guy. I'm a technical analyst, so all I really care about is what the chart's telling me. Despite what my thoughts are on the macro ideas, and I do have them. It's not like I don't, and it's not like I don't pay attention to the news and to what the bigger trends. I still base all my trades off of what the chart does. And right now, gold and silver are not charts that I'm particularly enthused about trading because there's so much overhead resistance, and these are equities that are stuck trading sideways at the moment and actually losing momentum. As you can see, with the moving averages, the 20 and the 50 crossing below the 200, price action below the 200. This is all indicative of an equity that needs to come back down. Now, silver, a little bit better, but this is a little bit of an aberration as well, because what we had here was when GameStop was running, you had this big crowd of traders that wanted to get into a lot of heavily shorted instruments, and that really hasn't worked out for anybody. So if we go back, the GameStop trade, for all intents and purposes, is dead, right? And when they were really right at the peak, when people were trying to replicate this, but without the same singular focus that that Wall Street beats had on GameStop, they tried to do it with AMC. They tried to do it with Bed Bath & Beyond, and a few others. And in the end, what ended up happening was it ultimately lasted for a few days and then kind of came back. And the other thing they tried to do was silver. And so it had a big pop based off of what was the hope of momentum continuing along that style of trade, but it really didn't pay off. And it's kind of right back to where it is, where it's been kind of stuck. And relatively speaking, it's doing better than gold or better than GLD. But overall, this is still not an equity I want to trade. I don't find this to be that interesting. I'd much rather, and I have been more heavily involved with cryptocurrencies. And as you can see, Bitcoin, massive move. Some of this based off of news that Tesla was going to start accepting Bitcoin as payment, and that Elon Musk bought like $150 million of it or something. And so a huge move. But again, it's not the news that matters as much as the reaction to it and what the chart tells us. And we were looking at it and showing that this was a kind of a critical area needed to break. And once it did so, it would be off to the races, and that's what's happening. But it's not just Bitcoin. Ethereum is running higher, and honestly, a lot of individual cryptocurrencies are really starting to run higher, and we're starting to get a little bit of the same exuberance that we saw in 2018. When the cryptocurrencies really ran wild. Now, could this eventually, or will this eventually end in a big drop, particularly in the smaller known coins that I'm not going to cover here? Very likely. However, this can continue and this can persist for quite a bit before that happens. And so, again, you're doing yourself a disservice if you aren't at least attempting to trade some of these other instruments, because the volatility that you get on something like Bitcoin, yes, it's scary, but the type of return that you could get on something like this, to buy this at 32, 33,000 and be able to pick up 16,000 in one move is pretty insane. And when you look at the risk that you had in place here, and you look at the reward, you don't get these types of moves in very many stocks, even with some of the explosive moves that we've had recently. And so it really, if you're really hurting yourself as a trader, if you don't try to learn these instruments and you don't try to take advantage of these types of behaviors. Now, it's the same, if you follow a lot of the Bitcoin crowd on social media, you'll know the whole joke about hodling, and how they don't like to give it up and they just hold it indefinitely because they don't think it's ever going to go down. I don't think that's really the case. I think any astute trader, any investor should have, at this point, should understand that Bitcoin and Ethereum are long-term investments. But that doesn't mean that your swing trades should be long-term investments, and doesn't mean you can't swing trade these and stop out at the right areas and trade them just like a stock. And so that's kind of important to understand. Is just like holding something like Amazon for long term, or Apple, you should also hold something like Bitcoin or Ethereum long term. But that doesn't mean that you should be married to all these cryptocurrencies, particularly the smaller ones, and not stop out or not trade them just like a swing trade in another stock that maybe you're just looking for quick moves. And so, you know, keep an eye on this. And if you don't trade this, you don't understand it. There's a lot of free information on the internet. Start Googling and start doing some research, because this stuff is important, and this stuff is going to continue to become more important as we move forward. I think a lot of blockchain technology is going to transform the way we continue to exist in a digital space. A lot like how the internet revolutionized the way we moved into the internet to begin with. And blockchain has that same kind of transformative power. And when you see this 5-10 years from now, you'll be like, why didn't I jump on this before? You might feel like you're late to the game, but the truth is that we're still kind of early into this. And sure, maybe, but you don't buy Bitcoin now at 45,000. Maybe you wait for the next consolidation range, but don't feel like just because you missed the move up to here that you're done. There's always an opportunity to get into these things at some point. Okay. All right. So if anyone has a chart request, now's the time. I kind of already covered my previous trades, so I don't really have any other stocks that I really want to cover at the moment. So if no one has a chart they want me to look at, we can pretty much just call it at this point. Just to reiterate, if you like what you see here, you can always follow me at Twitter. Let me put this back up real quick. Just look for Stock Darts at Twitter, and if you like my trade ideas, if you want more information, visit me at patreon.com/StockDarts, where, again, it's a blog. It has some stuff is under subscription, but usually the subscription is time-based, just to give those that are interested in trading the ideas the right access to it. But they usually go free after about a week, so that anyone that's interested in learning can still go ahead and see my thought process and why I go ahead and take those trades. So I highly recommend anyone that wants to go in there, go ahead and take a look. There's a lot of stuff on there. We're talking hundreds of posts, basically outlining why what types of trades I'm taking and why I'm taking them. Other than that, I hope you guys have a good rest of this week, and we will meet again next Wednesday.